everybody, it's Tortoise Investing. Today we are going to be going over some upcoming ex-dividend dates, 3 buy and hold forever dividend stocks, and my personal opinion and view on Google's whole Gemini controversy and everything going behind that. So this is going to be the format going forward that I want to do with this setup. Every Tuesday, every Friday, look forward to those uploads. Subscribe if you're new, hit the like button, hit the bell so you know when I do uploads, and on Saturdays I am going to be doing little live streams. So without further ado, let's go ahead and jump into it. Today we're going to be taking a look through Qualtrim Insights, Procter & Gamble, Hershey Company, and Deere & Company. And for the ex-dividend portion, I'm going to have timestamps for everything in the pinned comment down below. Philip Morris, Vici, Costco, AMT, and Deere & Company. So, taking a look here, Procter & Gamble got adjusted free cash flow yield of 4.06%, dividend yield 2.61%, payout ratio is just a little over 60%. This is an old reliable, been increasing its dividend for over 60 years. Now, the revenue's been growing at a rate of 4% over the last 5 years. The free cash flow has been increasing at a rate of 4% as well over the last 5 years. So this is just a slow, old reliable, if you will, very safe, very defensive. Everyone's got Procter & Gamble products in their house. Earnings per share has been increasing at a rate right at 10% over the last 5 years, so that's very nice. Got some almost double-digit growth going on there. And their financial sheet is beautiful. They have $23.56 billion in debt. Their EBITDA is $21.82 billion. My rule of thumb is I don't like companies that have more than 3 times their EBITDA in debt, because that could be showing that there's an issue with their balance sheet. But with this one, no issue whatsoever. They could pay off that debt, no problem. And they got quite a bit of cash on hand. The dividend's been increasing at a rate of 4.57% over the last 10 years. Very nice. Inflation beating. And when it comes to shares outstanding, they are buying back shares at a rate of 1.64% over the last 10 years. Take a look here over the last 5. And just slow and steady from 2020 till 2023. Looks like they bought back, 15 million shares and counting? Yeah, probably somewhere around there, doing some math. Another great thing with Procter & Gamble is they don't have to spend a lot when it comes to their CapEx. It's not just growing like crazy. So that's a thing to look for when you're looking into companies. If they have to grow CapEx to make money, it means they have to spend more money to make more money, and that's usually not an ideal thing. Next up, we got Hershey Company. I love this. This is a really big position in my portfolio. Just a free cash flow yield of 4.27%, dividend yield 2.62%, and a payout ratio of 46%. If you see here, it is in a downtrend. The whole Ozempic diet weight loss pill thing has really scared a lot of people out of the stocks very similar to this one. But I'm buying. I'm about it. When everyone is fearful, I'm running in. Over the last 5 years, revenue's been growing at a rate of 6.75%. The free cash flow has been growing at a rate of 12.76% over the last 5 years. Very nice. Love double-digit cash flow growth. EPS been growing at a rate of 10.61% over the last 10 years. Over 16% in the last 5, so that is accelerating. Very nice. And a very similar situation with Procter & Gamble when it comes to their balance sheet. EBITDA $2.06 billion, and their debt was $3 billion as of last year. Do an update quarter to quarter here, $3.7 billion. Still not an issue, still not even 2 times when it comes to that. Dividend's been increased at a rate of 9.41% over the last 10 years, but they have been doing bigger and bigger hikes of around 15% over the last 2 years. Very, very nice compounding going on right there. Shares outstanding, not too much to talk about, less than 1% buyback every year. Return on capital employed, 19% in 2020, 20.37% in 2021, and 21.81% in 2022. So very nice. Usually the industry average is around 9 to 10% when it comes to capital employed, and this is double that, and it's growing. I don't think we looked at that Procter & Gamble. Yeah, Procter & Gamble, same situation, over 20%, and it does look like it is trending upward. I do that a lot. I usually forget 1 or 2 things when it comes in, but I backtrack. I go back and get it. Next up, Deere & Company, adjusted free cash flow yield 3.65%, got a dividend yield of 1.52%, and a payout ratio real nice and low, below 15%. This was recently in 260 areas, so it might be something you want to put on your radar and see if it might drop back down. Deere has had a revenue growth over 10% in the last 5 years. Free cash flow 16.71% in the last 10 years. They have been doing very well here lately and are flooded with cash. EPS growth is 14.57% over the last 10 years. When it comes to their debt, they have 38 billion in debt. Their EBITDA is 17.48 billion. Again, falls in line with my rule of thumb, not more than 3 times their EBITDA in debt. And the dividend's been increased at a rate of 11.17% over the last 10 years. Thing to note with Deere is sometimes they do multiple hikes during a year, but if things are looking rough, they do not mind to pause that dividend. So that is something to keep in mind. But Deere & Company, I do like them. They have an automated system with their driverless tractors, which looks really cool. Make sure to check that out if you haven't and that interests you. But taking a look here, shares outstanding, been going down at a rate of 3% over the last 10 years. Very nice. And here recently, very quickly been buying back those shares, 6% in the last year. Love to see that, because when companies do share buybacks, you get a bigger and bigger piece of the pie. Very nice. And when it comes to capital employed, this is just growing like a weed. 2020 right at 10%, 2021 15.28, 2022 17.91, and 2023 over 24% ROCE. Very nice. And their CapEx isn't too much of an issue. It kind of fluctuates here and there, but there's no like 50% plus rapid growth with it. But yeah, Deere & Company, maybe something you want to put on your radar. No, this financial advice, by the way, is always do your own research. Next up, the ex-dividends section of what I was wanting to go over. We got Philip Morris here. It's going ex-dividend on December 20th. I'm recording this on the 18th, and it's going to be coming out on the 19th. So, December 20th is the ex-dividend date, and when it comes to ex-dividend dates, buying the day before the ex-dividend date makes it to where you are able to still collect that dividend when they pay it out. So, we got Philip Morris, $1.30. Ex-dividend date is on the 20th. Payday is January 10th. Vici is our next one, December 20th. Payday is January 4th. Amount 41 cents, 41 and a half cents. Ooh. And Costco is the next one we're going to take a look at. Ex-dividend date is on December 27th. Payday is the 12th of January. And this is a special dividend from Costco, $15 a share. They got so much cash they didn't know what to do with it. They didn't want to buy back shares because it is very pricey right now. So they are returning that to us, the shareholders, in the form of a special dividend. $15, ex-dividend date 27th December, pay date January 12th. Next up, we got AMD, American Tower Corporation, going ex-dividend December 27th. Pay date for that will be February 1st, 2024, and that amount will be $1.70 per share. And next up, lastly, we've got John Deere. They have an ex-dividend date of December 28th, and their payment amount is going to be $1.47 on February 8th. Now, our last section here, if you haven't checked it out, Google released this video of their new multi-module AI model called Gemini. And you can look this up on YouTube. It's on their main channel. But there is a lot of controversy behind it because it was very misleading. And it showed that the AI was just recognizing the guy's hands, and it looked like it was very quick and very fluid. But in reality, the AI was looking at pictures of everything, and there were text prompts, and there was a lot of behind-the-scenes stuff that went with it that wasn't included in this video. And that's kind of shady, I won't lie. That is, I liked what I seen at first. I was very impressed by it. But once it came out and, the truth came out behind it, not good. I don't know if this was just their attempt. They felt like they were so far behind when it came to AI that they had to kind of maybe sneak one in between the cracks, but it did not work out in their favor, and they are facing a backlash. The stock went up a couple percent when they first revealed this because everyone loved what they seen, and then it dropped a couple percent because they found out that it wasn't exactly what they shown off, you know. Um, I don't know the future of Google. I know that the company as a whole is doing great. They got YouTube, they got the Google browser, but the company in itself is facing a little bit of issues here and there. They do a lot of stock based compensations that's chopping into a lot of their free cash flow. So I don't know going forward. Obviously, if this was to drop again, like near the 100 range, I would definitely catch my attention. But right now, I'm just kind of watching it, and I'm hoping that they're able to redeem themselves. Because I love old Google. I love what they do. The Google browser again, like everyone uses that. It's on most people's phones. Everyone uses YouTube. The top two search engines in the world is Google Chrome and YouTube. So yeah, that just my quick little thoughts on it. Again, hoping to enjoy this new format. I'm gonna have everything broke down below. If you're new, subscribe, hit the like button, hit the bell so you don't miss out on future uploads. And until next time, take care. See you.